All right, welcome to this explainer. Today, we're throwing on our professional equity analyst hats to conduct a really rigorous financial autopsy. We're looking at a company called Spyre Therapeutics, and we're going to use some hardcore professional valuation models to try and decode its massive valuation. By the time we wrap up, you'll see exactly how financial pros break down intrinsic value and why this specific stock is such a wild puzzle.
Okay, check out this glaring contradiction right at the center of our mystery. We've got a staggering market cap of over $6 billion. $6 billion. But then you look at the trailing 12-month revenue and it's zero. Not a million, not 1,000, literally $0. And this number right here brilliantly captures the hype. A whopping 373.53% trailing 12-month return. Despite earning absolutely nothing, the market has bid this stock up into the stratosphere. And that sets up our central conflict today. How exactly do we value something that makes no money but is absolutely loved by the market? Here is our roadmap to figure out if this price is justified. First, the $6 billion mystery. Then, absolute valuation models, relative valuation multiples, asset valuation and NAV, and finally, our intrinsic value synthesis. Let's start with part one, the $6 billion mystery. Looking at the baseline metrics, the sheer scale of the cash burn is kind of incredible. With the stock closing at $69.42, the trailing 12-month net income is a negative $148.7 million, and free cash flow is negative $169.2 million. But the wildest part? The return on invested capital is a brutal negative 838%. Basically, every single dollar going into operations is just burning up in clinical trials. Moving right along to part two, absolute valuation models. Let's see if we can calculate the intrinsic value. We're starting with the absolute gold standard, the discounted cash flow, or DCF model. Normally, this tells us exactly what a business is worth by projecting expected future cash flows and discounting them back to present value using a required rate of return. But let's see what happens when we plug in Spyre's actual numbers. Yeah, so a DCF just completely implodes here. Our starting free cash flow is deeply negative at minus $169.25 million, and revenue growth is zero. To force this model to work, an analyst would have to wildly guess on drug approval timelines and plug in standard default assumptions, like a 2 to 3% terminal growth rate and a 5 to 6% market risk premium. Honestly, it turns into financial science fiction pretty fast. Okay, what about the dividend discount model, the DDM? Well, we hit an immediate brick wall. The DDM relies on expected future dividends. Since Spyre's dividend growth rate is exactly zero, with absolutely no indication they'll pay one anytime soon, this model is quite literally impossible to execute. So we pivot to the residual income model, which is normally a fantastic fallback when a DCF is fragile. We start with book value, then add the present value of future residual income. But look at these inputs. Net income is negative $148.7 million, and the return on equity is a severely negative 20.8%. They aren't earning their cost of equity, they're hemorrhaging it. So future residual income stays persistently negative, meaning this model also fails to give us a floor value. Since absolute models require way too much guesswork for pre-revenue biotechs, we move to part three, relative valuation multiples. These multiples violently show how far outside the normal guardrails this company operates. A PE ratio of negative 27.22, an EV to EBITDA of negative 23.60. You simply cannot compare these negative metrics to a mature, profitable peer group. To even attempt relative valuation here, you basically have to throw out the rulebook. You must assume a peer group of other zero-revenue clinical stage biotechs. You stop looking at trailing financials entirely. Instead, you're valuing scientific pipeline potential and the total addressable market. The implied intrinsic value here? It's an exercise in valuing hope and probability, not historical metrics. Searching for some hard, indisputable financial grounding, we arrive at part four, asset valuation and NAV. Let's hunt for value right on the balance sheet. Now, this number is absolutely vital. 13.25 is Spyre's current ratio, current assets divided by current liabilities. In plain English, they are sitting on an absolute mountain of cash relative to their short-term obligations. That high liquidity finally gives us a real mathematical foundation. Let's calculate the net asset value, or NAV, by adjusting the balance sheet.
It's a simple three-step process to find a baseline intrinsic value. 1. Grab the current stock price, which is $69.42. 2. Identify the price-to-book ratio, sitting at 7.59. And 3. Divide the price by that ratio to find the implied book value per share.
Let's do the math. 69.42 divided by 7.59 gives us an implied net asset value of roughly $9.14 per share. After all those broken cash flow models, this $9.14 represents the hard, tangible fair market value of the assets the company actually owns today, minus its liabilities.
All right, part 5, final intrinsic value synthesis. Let's bring all our clues together for the verdict. This synthesis dashboard beautifully summarizes our entire financial autopsy. DCF, extremely low reliability. DDM, 0. Residual income, very low. Relative multiples are highly speculative. The only thing that provides a mathematically reliable, high-confidence floor is our asset-based NAV at $9.14 per share.
So here's the crucial takeaway from this whole explainer. The current price is $69.42, but our most reliable model says the shares are fundamentally worth $9.14. That indicates massive fundamental overvaluation. The $6 billion market cap is entirely a premium paid for future scientific success. Our financial models look backward at the cold, hard math, but biotech investors, they are looking entirely forward at the story. So our verdict? Technically overvalued by traditional metrics, but accurately priced if you view it as a pure story stock.
Which leaves us with this final, provocative thought to ponder for your own portfolio. When you look at a zero-revenue biotech giant like this, are you investing in the math or the mystery? Thank you so much for joining me on this deep dive. Stay curious, and I'll catch you in the next explainer.